Well, good morning and or good afternoon, depending on where you find yourself today. Thank you for joining us for the first of a number of webinars and soon to be podcasts, more coming on that from Composition Wealth. I am Nate Angelo, have the privilege of serving on the leadership team here, and I'm really excited to have Matt Dmytryszyn, our CIO, Brian Bunker, our head of fixed income, and Rusty Haas, our head of equities, joining us today for a conversation that we've entitled Markets in Motion. And really, the goal of today's conversation is not to just be another dialogue about what's the economy and the market going to do in 2026. Certainly, we have thoughts about where it's headed. I think there's some key themes to draw out of that. But I think what's more important is what are we actually doing as a result of the things that we think may come to fruition in 2026. And then I think where all of this really comes together is really helping clients ensure that they are putting real purpose behind their money, and that money is actually working for them through allocation, through ownership of different types of securities, to meet the outcomes that you all have desire to come to fruition. And so it's our job to bring all of this together. And so we're really excited to have this group and to make this engaging. One logistical point I'll make, there is a chat button, a Q&A button at the bottom of your screen. If you click on it and you type in a question, we'll either weave it in as we go, or we'll pull it up at the end to keep conversation flowing smoothly. But we'll make sure we address questions. And if you have something really specific, we're happy to reach out to you in a one-on-one setting as well. So let's jump in. Well, if you've been reading the headlines, if you've watched any of the market channels, you're certainly hearing a lot of optimism for 2026. Also, always caveated with a few, hey, but this could happen or that could happen. Matt, why don't you maybe set us up for the tail end of 25, maybe just a couple of comments on what did 25 entail as a setup for what do we see happening in the economy or the market in 2026 more broadly, recognizing that I think it was just yesterday or Monday that the S&P 500 hit a new all-time high, and so here we are gathered, some momentum behind us, but what do we see as a group for 26?
Yeah, you're right to frame it, Nate, where we kind of got to think about where we've gone in 2025 and how that sets us up for the kind of the new year ahead. And just to kind of share maybe our kind of graphic depiction of how we're thinking about it. When you look at 2025, the economy was healthy. We haven't gotten fourth quarter, gross domestic product or economic growth yet, but it seems like the economy's on pace to kind of grow 3 to 3.5% for 2025. But when you peel back below that, there was really two pillars holding up the economy in 2025. The first being artificial intelligence spending, so the significant dollars spent on building data centers and supplying the chips to it, and the energy infrastructure and the cooling capabilities, and all that goes into a data center. The second piece being what has remained a really healthy and robust consumer, particularly among high-end consumers. We'll talk about that in a second, that they really held up the economy as well. So if you think about that, call it 3.5% growth in the US economy in 2025, about 1% came from artificial intelligence spending, and call it 2.5% came from consumer spending, heavily skewed towards higher end consumers. The rest were kind of puts and takes to the equation. To your point, Nate, kind of as we look ahead, we actually are optimistic on 2026, largely because I think of some of the measures put in place in 2025, they're going to provide some stimulus. The first being the Federal Reserve cutting interest rates during the year. They're going to, report a latest interest rate move with expectations be that they'll hold here in the next hour or so. But kind of that does lower interest rates, particularly among shorter term borrowers. So it hasn't really impacted mortgage rates materially, but those that borrow on shorter term interest rates, so a lot of that is corporate borrowers, some real estate investors, that's helped their lending rates. The second piece being the One Big Beautiful Bill Act legislation. And before I get into that, I do want to kind of put out the disclaimer. We are very apolitical in what we do. We just want to look at the facts coming out of it. We're not here to render a view on whether the policy is good or bad, but just what are the ramifications of that policy. And so when you look and peel back the One Big Beautiful Bill Act, it did kind of provide some stimulus for tax deductions around tip income, overtime pay. So things like that we think are going to help, and they're actually going to more likely than not help, at least for a period of time, lower income workers, where that's more likely to have an impact. The other piece of that One Big Beautiful Bill Act was allowing corporations to accelerate depreciation on infrastructure and capital spending. So building a new factory, outfitting that factory with equipment, we think that's actually going to lead towards an acceleration of capital expenditures, where if you actually look at corporate capital spending and you remove artificial intelligence, the last several years have actually been a reduction in capital spending. So there could be signs that that's going to accelerate. In fact, some of the data we got the other day just on durable good orders, which are big purchases, actually indicated that maybe that's orders are starting to happen around that. And then I think if we get some clarity around tariffs, I think a big piece that maybe led to that reduction of capital spending last year was just companies were less comfortable in the policy environment to make big decisions. And I think as they start to better understand policy and where it's going, that could lead towards more comfort in kind of making those decisions. And so the hope is all of these different measures leads towards a more robust economy, where it's not just two pillars carrying the economy like it was in 2025. It may be a more robust economy in 2026. And so as I kind of peel back that a little bit more on the consumer spending, so this chart here highlights kind of on the right is kind of wage growth by consumers. And this is using Bank of America's data. It's the Bank of America Institute. They just take their checking account and credit card customers and they just take them in thirds. The lowest third is the lower income, the middle third is the mid, and the highest third is the high. And what you can see is wage gains haven't been as great for among lower and middle income consumers. They've been the highest among higher income consumers. And then this chart on the left looks at credit and debit card spending. And what you can see is that orange line, which is higher income consumers, are actually seeing a higher rate of spending. If you incorporate inflation in there, it's really higher end consumers are the only ones spending at a greater rate than inflation. Lower and middle income consumers are kind of more in line with inflation. And so that's really driving this. When we're seeing stronger consumer spending, it's happening, but it's a more nuanced cohort of consumers doing that spending. The other piece I wanted to share on the economy, but why we're a little bit more optimistic in 2026, is this chart on the right. And this is provided by JP Morgan Asset Management, but their expectations are, because of the policies put in the One Big Beautiful Act bill, you're probably going to see, call it close to $1,000 more on the average tax refund in 2026. That's obviously going to be a wide variance and bifurcation depending on that individual taxpayers, the composition of their income. But that should stoke some additional spending and stimulus, especially as we, kind of get deeper into tax season, which is just kind of started. And then the last piece to highlight just on the economy is inflation. So we obviously had peak inflation went over 9% in 2022. That's just been on this steady deceleration. What I show here is we just go back to the end of 2023, so kind of taking a 2-year snapshot. And what you can kind of see is for most of the last 2 years, inflation's kind of ebbed between 2.5% and 3%. That's kind of where we sit today. A lot of talk of, okay, there's tariffs. Those tariff prices haven't been passed through. Are we going to have more inflation? I think there's a component of that, but there's other deflationary forces going on. Right now, there's actually an excess supply of housing, particularly among apartment buildings. There's a lot of supply that hit in 2024. That's still being absorbed. So we're actually seeing nationally, rents are about flat year over year. So that's actually easing inflation, and shelter is 44% of the consumer price index. So that's going to actually kind of be a downward pressure on inflation. Oil prices, while they're up a little bit this year, are still down. Those are coming down. And food prices have been coming down. So if we actually think, my view is we actually may see inflation in 2026 closer to 2% versus 3%. However, once those apartments are absorbed, there's likely to be more rent growth because there's not a lot of the units being constructed right now. Oil prices go up and they go down. We're in the downward trend. There's likely that oil prices over a multi-year period go higher just because the economics at $60 a barrel are less attractive to drill new wells. So we actually think supply gradually starts to come down. So I think there's a number of kind of puts and takes. And then energy prices is another one. If you're like me, you've noticed it in your power bills each month, and that's likely to continue to go higher. I've seen some estimates of anywhere from 4 to 6% kind of growth in utility costs over the next 5 to 10 years. years. So we actually think if you ask me what I think inflation is going to be in 2028, I actually think it's going to be closer to 3%. So I think it's important on the inflation side to just keep in mind, we may be seeing an easing inflation that probably starts to go higher as we look a year or two further out. So that's kind of our broad strokes base case expectations on the economy, Nate.
So flattening inflation, trending lower on interest rates, energy, oil prices on the rise. Like generally speaking, Matt, like feels like the first theme I'm hearing here is reasonably optimistic.
Yeah, I think
from an economy perspective. Now, does that correlate 1-to-1 for continued, double-digit returns in the market? I think that's a different conversation, and we're going to dive into that in a minute. And candidly, like that's the more fun part of this, if you want my honest opinion. Number two, I heard the second theme here. That's like, hey, we got to separate our politics from our portfolio. Like we have to be really clear about what it is we're trying to accomplish, leveraging the financial plan and then deploying appropriately and creating a portfolio that creates purpose for that plan. And then lastly, which is where we're going to launch off into here to talk about markets, is this idea of diversification. I think diversification is a trigger word for a lot of people. Diversification sometimes, I think in my view, is code for boring. You're just going to own all of the market. And I think what we're talking about from a diversification perspective is not just own everything. It's actually a little bit different. It's make sure you really know what you own. Ideally, we're trying to own the winners. And that doesn't mean just stocks and bonds, but we do think that there's more opportunities to own some different and or unique things that will create opportunities for us more broadly. So as we unpack the next 20 minutes or so, like these are the three broad themes that I think we're anchored to. And so like let's actually make this transition from economic conversation, which is typically seen as pretty theoretical, and now let's actually dive into more of the practical. So how should we be thinking about the markets, the equity markets specifically, and what we can expect from a return expectation in 2026?
Yeah, so you're right, Nate. We're kind of more optimistic on the economy as we look into 2026 and possibly even beyond that. I think for the markets, the key word we're using is moderation. We're starting in an environment where just valuations are a little bit more, they're fully valued to, in some parts of the market, maybe a little bit rich. And so, if you actually put that in context, you go back to the lows of October of 2022, not that long ago, a little over 3 years ago, the equity market, the S&P 500 is up 100% since then. So we've seen a strong economy, but we've seen the markets grow with that economy, if not a little bit higher. So that leads to valuations that are a little bit above average. And so we kind of think going forward, you're not going to get further kind of valuation expansion from that. So a framework we use, and not to try to get too into the weeds, is we kind of think about the S&P 500. And you take all 500 companies in the S&P 500, you add up what their earnings are going to be, and you get the earnings for the S&P 500. For 2025, it's going to be about $265 to $270 worth of earnings across those 500 companies per share. And then this year, kind of expectations are about $310. So you're looking at kind of low to mid-teens kind of growth. We're entering the year where the market is willing to pay 24 times those earnings in the overall valuation of the market. To put that in historical context, the average is around kind of 17 or 18. So we're a little bit above that. But you talk to, Rusty on our team, and he would sit there and say, but when I look at the market, it's as high a quality as ever. And you're looking at an Apple and a Google and an NVIDIA, their balance sheets are fortresses. They got tons of cash. They're generating a lot of cash. Their profitability is through the roof. You should be willing to pay a higher valuation. And we believe that. It's just a question of what that should be. And so we put that in this framework and kind of look at, well, what's the range? What if we get a stronger economy than we think, and we're actually, the S&P is going to make $320 worth of earnings, or it's a little bit weaker and it makes 300. What if people are willing to pay a little bit lower of a valuation multiple? And that kind of gives us this range. I think the high probabilities, we get a range kind of in this, yellow to green area. And, our kind of base case would kind of say maybe you get 8.7% if we kind of keep our multiples where we're at, keep valuations where they're at, and you kind of get earnings as expected. And so that's a moderation from last year when the S&P was up 18% the prior 2 years and it was north of 20%. So moderation does not mean negative. Moderation means look, maybe over the next several years, it's not going to be double digits like we've had. This piece is an interesting one. It just kind of looks at historically what's the relationship between where the valuations are at on the S&P 500 and then what's that return over the next year. This is a really bad predictor over the next year. It tends not to work, but if you look over a multi-year period, that starting valuation does have some relationship to what that future return is going to be. And this would kind of tell you mid-single digits, maybe high single digits, but at least a moderation from kind of where we've been over the last few years. So that's kind of our starting point, I guess, on returns. But I think there's more to the story than just returns. We actually think there's going to be a broadening in the market. And I actually like to hand it to Rusty to kind of talk about how he's thinking about that broadening in the market going forward.
Yeah, thanks, Matt. So if you go to slide 9, Matt. Yeah, so what this slide will show you is on the left-hand side, you can see returns for the Mag 7 stocks from 23, 24, 25 relative to the S&P 500, which is the green bar. So in other words, the Mag 7 stocks, the big tech stocks, have outperformed over the last few years. In last year, we actually started to see that a little bit more dispersion, and with one or two stocks outperforming the S&P 500. And as we kind of think about 26 and even into 27, we think that is probably more likely to continue. The right-hand chart on this slide, if you look at the magenta dotted line, all that really is it's a 10-year average of how stocks are correlated. And you can see in more recent years, there's less correlation. And so in other words, a lot of the performance has been concentrated in those mega cap tech stocks. And if you go to the next slide, there's another, the weight of the top 10 companies on the left-hand side of this slide is another way of depicting that story. And all this really tells you is that 10 stocks in the US have done really well, and they're now widely owned. I think if you look at this slide, the right-hand part of the slide is probably the most important part of this story, and that is the light blue is the earnings growth of the Mag 7 stocks on a quarterly basis, and the dark blue is the remaining 493 stocks in the S&P 500. And so what you see is everything else in the S&P 500 is starting to accelerate, and this is that broadening theme that Matt talked about. And so everything else is starting to do better in the S&P 500, whereas the Mag 7 is still doing quite well and will continue to do quite well. But we just think that there's more opportunity outside of mega cap tech. And by the way, in a bull market, which we think we're in, that is something that's very healthy. Is you need, it's a lot better if a lot more stocks are doing better because those companies are showing earnings growth. And I think the last thing I'd say here really is that, for us, earnings growth is really the most important thing that we look at. And so stock prices ultimately follow earnings growth, and that's where our focus is.
So we talked about returns, being a little bit more moderate than maybe where they've been the last, 5 or 6 years on an annualized basis. One thing we didn't dive into in great detail, and I don't think that's the intention, but it is a factor, is also just, geopolitical instability, I think has increased in the last number of years as well. And so when you combine these two factors, Matt, how are we actually taking this information and driving it into portfolio construction? This is where we actually get into the application of what are we actually doing at Composition Wealth inside of our portfolios.
Yeah, I think when you think about geopolitical stability, or as I like to think, it's just an accelerating rate of news flow these days, and that you've got to think about and sometimes react and sometimes not react. And so a lot of what we're starting to think about is what is the range of scenarios, what is the range of outcomes that can come about, and how do we balance portfolios for that? So you mentioned it earlier. it is diversification, but diversification is an overused word. We're thinking of diversification beyond just stocks and bonds in a portfolio, but within the stocks, how am I diversified? How am I diversified by different scenarios if one thing happens or if another thing happens? And so, maybe on the fixed income side is a great example of kind of how we built some of that in some of our taxable portfolios. Brian, do you want to kind of talk about what we've done on the bond side of things?
Absolutely. So we've added TIPS and international bonds to our taxable fixed income strategies. It's really with the goal to add diversification and improve returns in various scenarios, just given the high level of uncertainty in the markets. Maybe first on TIPS, for those that aren't familiar with TIPS, these are U.S. government bonds that protect from higher inflation, where the payments you receive increase as inflation increases. And we like TIPS as part of a balanced taxable fixed income portfolio to protect against inflation and maintain purchasing power. Inflation expectations have recently picked up due to a number of developments, so we've actually benefited from having some TIPS in the portfolio. Outside of TIPS, we've also added international bonds to our taxable fixed income strategy. By accessing international fixed income markets, we can improve diversification through gaining exposure to debt markets around the world with different economic cycles and yield curve dynamics. And we have a lot of confidence that that active managers are able to find the best opportunities around the world. So another thing that we do like about international bonds is that they've historically produced slightly higher returns than treasuries with lower volatility. Rusty, I don't know if you wanted to talk on equities.
Yeah, so I guess we've talked about U.S. and diversification or the broadening out of the market in the U.S., but diversification also means being invested outside of the U.S. So big picture, there are 8 billion people in the world. 60% of those people are in Asia. Asian GDP accounts for half of the global GDP, and 2/3 of global GDP growth or economic growth happens in Asia. So it's a very important region for us and for the world to follow. And I want to talk just briefly about a couple things that we're looking at we like. So South Korea has the 2 largest companies that produce memory, and memory is a key input for the AI build out. And so South Korea market is a very important market that's seeing pretty significant earnings growth. It's half the valuation of the U.S. market and is growing twice as fast. So that's a country that we like outside of the U.S. Similarly, in Taiwan, the Taiwanese economy is heavily dominated by semiconductors, also a key input into the build out of AI. Taiwan Semiconductor, you may know, is the most important semiconductor manufacturing company in the world. It's the only company at mass scale can produce NVIDIA chips required for the AI build out. Taiwan, again, at a much more attractive valuation than U.S. markets, growing a lot faster. Taiwan is another area that we like. If you think about, and you've probably been hearing about the commodity cycle maybe starting to turn up after many years. And so Latin American economies, Brazil, Mexico, smaller countries like Peru, are big beneficiaries of this reflationary or this commodity cycle turning up. That's an area we like. And then lastly, you think about Europe. In Europe, you have this dynamic of now your deficit spending. So in other words, a lot of these countries are acting and providing stimulus, whether it's in defense spending, taking defense spending up, double over the next 10 years based on what's happened in Russia and Ukraine. There's also, some tax stimulus happening. Labor markets are being reformed. So there's a lot of stimulus happening in Europe. And so that's another area that we think has attractive returns relative to the U.S. And so, the message is really diversification is important outside of the U.S. to have non-U.S. stocks in your portfolio. And it's not for just purposes of having it. It's actually areas where we see faster earnings growth and more attractive valuations. And the last thing I'd say is the U.S. is the most dynamic economy in the world. There's no debate about that. But there are opportunities outside of the U.S. that we think is really important for client portfolios.
It's good perspective, Rusty and Brian. And like as you set this up, Nate, you kind of talked about we've got this evolving geopolitical and just policy landscape. You tie that with our earlier comments on just moderating returns. It is kind of an evolving investment environment. Like, when I think about our clients, how can they best kind of leverage their composition wealth advisor in what is a kind of transitioning environment?
Yeah, I think it's easy to fall into this trap as an investor. I mean, we all have this innate desire for what is the highest return we can get. And sometimes chasing that higher return is not actually necessary to fulfill all of the things you are wanting to accomplish in life. And so, especially in times like this, when you've been the benefactor of a market that's run significantly, now you have increased uncertainty in parts of the market. You have increased certainty that things have underperformed, will either revert to the mean and or have greater opportunities for growth. It's a great time to actually sit down and reorient yourself around your financial plan, your goals, your objectives, and then work backwards to your portfolio to just check yourself to say, hey, am I comfortable now with the volatility that my portfolio may contain? And is it really necessary that I need to take that risk, or should I be rethinking about the bonds that I own? I know for the last number of years, everybody said like this is a great time to own equities. Well, I think as bonds this may be a place where you want to own more bonds on a go-forward basis, especially if you're partnering with an advisor or a group like Composition Wealth, where we're actively managing what those bonds are. We're not necessarily just owning a type of bond. And so I think this is a great transition for us to really dive into. We've talked about at a high level overall allocation, diversification, but now let's actually talk about what are we doing inside the portfolio at a more tactical level. And so let's talk about, what are some of the thematic trends that we really like? What does security selection look like? And so, maybe Rusty, we'll start with you on this idea of thematic trends, and then we can work through what are we doing in the bond side on security selection? And then Matt, we'd love to open it up and talk about private markets as well. And I'll weave this in right here, Matt, to give you a chance to think about it. So this question came in the chat, and it's around gold. And with geopolitical instability, let's say increasing, or the potential for instability increasing, is gold poised to continue to be a very strong, macro hedge, similar to how it performed in 2025? And so, Matt, maybe when you get to private markets here in a minute, you can weave in a comment just about gold itself. But Rusty, maybe you could talk about what are the things you're seeing from a thematic perspective that have you really excited or intrigued about their potential.
Yeah, thanks, Nate. Just 4 themes that I think we're leaning into that are important. One is, so if you think about interest rates over a 40-year period, for the majority of that 40-year period, interest rates have been declining. Then we saw this move up in interest rates. We think that interest rates, long-term interest rates, probably on the 10-year, maybe between 3 and 6%. And we consider that to be higher for longer. And so if you think about who benefits from that, banks are a natural beneficiary there. We're leaning into banks. That's because they can lend at those higher rates and they pay their depositors or their liabilities at shorter rates. So that improves the profitability of banks. Banks have been hated for, better part of 20 years, under-owned, attractive on valuation, all of those factors. So banks, financials and banks in particular is one area. Another area is just on the AI infrastructure and the AI build out. So if you think about all of the companies that are going to likely benefit from AI, that can be insurance companies, that can be all sorts of different companies. So it's really about this broadening of the U.S. market. And as those AI adoption rates improve, we like those areas that are highly, more high skilled labor, where the costs can come down, margins can improve. So those companies that benefit from AI. I think also I just think it's important to mention a lot of the opportunity in AI or native AI companies are still private companies, not even on the public markets yet. AI really democratizes the creation of new businesses and new opportunities. So innovation and entrepreneurship, small founders, I think that, that is another area, and that's going to happen all over the world. In India, we're starting to see quite a bit of it, where this venture capital market in India is starting to expand pretty rapidly. Third theme would be industrials. So industrials, we've been aerospace and defense is where we've been had a lot of exposure. That's done really well for us. I think traditional industrials is another area, and the reindustrialization or the reshoring of manufacturing in the U.S. Those are traditional industrials, transportation, manufacturing, machinery, those types of businesses. We like that as a thematic trend. And then just lastly, going outside of the U.S. again, India. So India, population 1.5 billion people, median age there is 28 years old. The U.S. it's 38, in Europe it's 40. I mean, you have a very young and rapidly growing population. If you look at the middle class in India, is going to be larger than the U.S. in the next couple of years. So it's a consumer driven market, and there's a lot of innovation happening in India. So I think also it's important just to mention the debt side of things. India total debt to GDP is half of the US, half of a lot of more developed economies. So we think having a dedicated exposure to India is important. It is the fastest growing large economy in the world. So 4 themes: higher for longer, so banks, AI beneficiaries, industrials, and India.
Brian, maybe you want to touch on some of the things that we're thinking about in fixed income specific to that how are you approaching the overall portfolio construct? And we've actually made some changes in our portfolios recently, and maybe even want to comment and share some of those insights as well.
Yeah, absolutely. So here at Composition Wealth, we do manage internally an investment grade corporate bond portfolio for clients. And we're really focused on investing in companies that we think will do well in the current economic environment, that generate strong cash flows and are focused on reducing their debt. Yields have come down some over the past couple years, but they do remain attractive when you're comparing that to where they've been over the last 15 years. And that's really due to the high treasury yields as corporate bonds trade on a spread to treasuries. Matt, if you flip to slide 12, we can look and see that the additional spread compensation that you're getting is on the smaller side right now, but for good reason. Balance sheets and credit metrics for corporations are very healthy and are trending in a better direction relative to the U.S. government. That's the picture on the right. But given there's not a lot of spread pickup by going down in credit quality, we are avoiding the riskiest investment grade corporate issuers. And the slide on the left shows you're not getting a lot of additional yield by increasing credit risk. So we're staying in higher quality companies at this point in time. We do believe that a dynamic approach is appropriate. For example, last year we were up in credit quality going into the tariff announcements, and we really used the sell-off post that announcement to add risk and ultimately deliver strong returns for clients. Looking forward within corporates, we are currently overweight in banks and aerospace and defense companies, just given both those sectors have really strong tailwinds. And we're having minimal exposure to tech, just given a number of companies in that sector are expected to increase their debt levels to fund artificial intelligence related capital expenditures. Matt, do you want to mention some of the opportunities in private markets?
Yeah, and I think that's, private markets do carry an element of illiquidity to them. They're not appropriate necessarily for everyone, but those where you're comfortable with a segment of your portfolio being in private investments. One of the things we've seen, and Rusty alluded to this, is there's just different assets available in private markets than in public markets. And a great example that he listed was, yes, if you want to get exposure to AI, you can get NVIDIA and Google and Meta and so forth. But within private markets, you've got some of the also growing household names in OpenAI and Anthropic and others. But there's also a layer below that of evolving companies that are going to be the household names in a couple of years that experienced growth-oriented private equity firms are spending a ton of time looking at, and these are the firms we've been spending a lot of time talking to broaden our own understanding of the space. So that's one example. Another one could be just kind of on the infrastructure side of things, getting access to whether it's transportation assets or power generating assets that aren't available in the public market, but actually have some nice secular trends behind them. Rusty talked about kind of the onshoring trend that is going to be over an extended period of time. It's not just going to be a 2026 theme, but that being a trend that infrastructure can support. What we're seeing on power generation needs, where we've had 20 years of 0% growth in power demand that's now projected to be 4% or more over the next 20 years, there's going to be a significant need for power generating assets, and private infrastructure strategies can provide some exposure there. Again, not for everybody, but it is an area where it can provide added diversification, but also exposure to assets you're not able to get in the public markets. So that being that piece. And then to highlight the question or answer the question you asked, Nate, around gold, it's a tricky one and it's a fun one. When you look at Rusty or Brian or myself, we're very much, cash flow investors. We focus on what is the cash flow an asset is going to give us, and then we can kind of have our own projections about how that grows, and we have a view on what that asset should be priced at. Gold's a little trickier. It doesn't give you any cash, but it's clearly an asset that has some value. That value is just really dependent on what that next incremental buyer or seller is, or really the buyer, is willing to pay for it. And so when you look at the bigger picture on gold tends to be very episodic and have these moments where it does particularly well. It's actually more volatile. If you look at its price volatility, it's more volatile than stocks. So returns are different. So it kind of brings that different return pattern to your portfolio, but it is by no means a low volatility asset. When you kind of now step back and put it in the context of today's environment, it's being used by many, or some are viewing it as kind of a, hey, this is my hedge against a debasement in the US currency. If people stop buying treasury bonds or are less tied to the dollar. And I guess I would answer that by saying, I think while that could occur, I'm not going to refute that. It's going to take a long period of time for the US dollar to get displaced. First of all, there's not a very apparent alternative to the dollar, number one. Second, there's a lot of global trade is tied to US dollars and contracts. Oil is only quoted across the globe in dollars. And so you've got a whole infrastructure that's tied to that. The third piece being what we have been seeing around gold is increased buying, but it's really been happening honestly over a period of 25 years. So if you go back to the year 2000, global central banks, so other banks similar to the Federal Reserve, they keep what they call foreign exchange reserves. So they actually have foreign currency at their central banks, and those are used to help manage their currency. If their currency gets a little weaker, they can, sell some of another currency, or they can also help underlying businesses in their country if they need access to more US dollars. They can exchange yen for dollars and the like. Well, in 2000, 70% of global currency reserves were in US dollars. That over the last 25 years has declined to 25%. There was a significant acceleration of that in 2014 when Russia invaded Crimea. There started to be more central bank buying because the US started to impose restrictions on Russia, and that led to other countries saying, maybe I want to own a little less dollars and more gold. So the point kind of being, this actually trend has been going on for the last 10 years, and it hasn't been overly disrupted. The recent kind of rhetoric is, well, central banks are continuing to increase their buying of gold, especially given kind of some of the tariff policies. And actually that's not what we're seeing. And so if you look at, there were elevated gold purchases by central banks in 2022, 2023, and 2024, over 1,000 metric tons. In 2025, that's on pace for about 800 metric tons. So about 30% less purchases of gold by central banks in 2025. So that diversification is transpiring in central bank reserves and more central banks buying it, but it's actually at a decelerating pace. The last piece I would say is, and I think what you're seeing then, and why is gold prices rising if central banks aren't buying as much, it's definitely much more speculative buying. Two data points on that. One of the biggest proponents of gold is the World Gold Council. They have their own model that looks at the fair value of gold, and they're seeing there's 30% of the price in gold that they can't attribute to anything. And so that to us is really a sign that it's more speculative. So their model kind of looks at where flows into golds are going to be where the buying power is, and it's really saying that's more coming from speculative behavior. At least that's our interpretation of their model. The other piece is if you look at gold's, sibling in silver, the largest silver exchange traded fund 3 months ago had 25 billion in assets. Today it's 55 billion. So in 100 days, that ETF has more than doubled its assets as the price of silver has gone parabolic. So what all this means is when we look at the trends, clearly there could be some favorable demand drivers to gold, but the demand drivers aren't at a level where we think it justifies kind of this significant move in the price of gold, because it's really more speculative behavior that's driving this, not long-term gold investors, and it's more speculative gold investors that we've seen coming into the market. And our concern is that creates downside risk if the rhetoric changes and some of that starts to sell out.
Love it. Now I'm going to double down and put you on the spot again.
Thank you, Dave.
Diversification. We're talking about it. I know this is an area that, everybody has a lot of thoughts on crypto. Maybe just make a comment on, Bitcoin, Ethereum, Solana, like all these different coins, and let's just lump crypto. How does crypto play into sort of the same similar theme around being a hedge? Any thoughts or perspective?
Yeah, I think it's similar to gold, but we have more conviction in gold than crypto. I think the challenge with crypto is a couple things. First, when we build portfolios, we want to make sure we avoid big negative downside outcomes. We've passed on a lot of ideas where we see big upside, but we also saw a risk of big downside. And I think that's the concern to us is not that crypto disappears, but maybe 10 years from now, it's not Bitcoin, it's Solana, it's a different currency. And so that is a concern to us of you have an asset that could go to zero just because it's displaced, number one. Number two, central banks are disincentivized to have another currency out there like crypto that they have no control of. It's really hard to control monetary policy when you don't have control of the entire money supply. And so we also see that as a particular risk to that. And then the third is similar to gold. We actually see it as a more speculative asset. It's hard to value. How much is it worth? It's really what that next investor is willing to pay for it. And you've seen that in the volatility of crypto. And then I guess the last piece I'll add, and Brian and Rusty, feel free to add on top, is just how Bitcoin could fit into your portfolio. We did an exercise where we said, okay, what if we added 2% of crypto to your portfolio? What does that do to your risk? Well, it took a portfolio that was a 60% stock, 40% bonds, and it basically took its risk level up by 20%. And so a little goes a significant way in just driving your risk. So all those kind of lead us to sit there and say, look, it is a speculative asset. It could double over the next year. I don't have the answer to that, but it's not something we feel is appropriate for the base of our clients' portfolios.
Yeah. So Rusty, going to put you on the spot with another question that came in. AI build out, right? A lot of money's been invested. I would actually say that you're starting to actually see some positive impacts start to sort of filter its way out into the broader market in terms of what some companies are able to display and start to do and deliver. And candidly, like just as an everyday human that's interacting with AI driven or AI inspired capabilities, candidly didn't exist 3 years ago for me to just, access. So I think there's early returns on it. How do we think about, or what should someone think about what's realistic to say, hey, based on what's been invested in this space, like over the next, whatever year or two, we should start to see more meaningful impact as a result of AI? Or is it, over the next 10 years, we should be looking for real impact out of AI? Just trying to help people understand and get realistic expectations around the investment that's happened to date, the investment that continues. Like, how do we wrap our brain around that?
That's a really good question and a tough question. I think the way that we've thought about it is what is the return on investment? And so if you take the total amount of spend on AI, what return would be needed to make that an attractive investment of 8 to 12%? It's a large number, and it's years into the future. So, I think the one way that we've thought about it is the initial spend on a data center, about half of that, half of the economics go to one company, NVIDIA. NVIDIA obviously has been, the winner. Um, Most companies don't want to rely or have a sole source of chips on NVIDIA, and so you're starting to see that broaden out. So that economic pool will start to expand outside of NVIDIA. There is, I think, some risk that there will be an overbuild in any of these big themes or paradigm shifts we've seen historically in technology. There's always a bubble. So at some point there will be a build out and probably too much capacity built out. And I think that's one of the reasons why we talk about the broadening of the market. So who are the ultimate beneficiaries? I mentioned briefly insurance companies. So if you think about an insurance company being able to get a claim to pay to pay the claim, all done via an AI model, that eliminates a lot of labor and improves margins. And I think you can take that same dynamic and put it to consumer staples. You can put it to all sorts of different industries. And so the ultimate beneficiaries of AI and the build out of AI will be, broadly speaking, U.S. economic growth. We are at peak margins. Margins probably can go even higher if we start to see efficiency. The last thing I'd say is, if you think about an economy grows by more people in the labor force, credit, so the ability, more money, the ability to borrow money, and then productivity, those three buckets. And we know the labor force is not necessarily growing in this country. Credit necessarily has not been a problem. That continues to grow, but it's really productivity. And so you started to see that big productivity improvement in the last couple of quarters. We think that continues. And that's what really probably supports economic activity going forward. So not a specific area that I would say, but I think just the theme of the broadening out of the market is probably the biggest beneficiary.
Rusty, coming right back to you. EU, India, they're in conversations with the deal, partnership potentially. Like, how does that potentially impact, the US and or views on India?
Yeah, I mean, if you think about what we get from India is IT service, health, drugs, generics. A lot of the generics globally are made in India. I mean, these trade deals, I think, the net, it's not necessarily a positive for the U.S. And you see that reflected in the U.S. dollar. I mean, I think that's one thing we're keenly focused on. So the U.S. dollar was down about 10% last year. It continues to decline this year. I think that's really kind of a temperature check of what global investors are feeling and thinking. So that specific trade deal, EU and India, is probably really good for India and probably really good for the EU. And you've seen tariffs come down as part of that transaction. I think so that's good for both of those geographic areas and not necessarily good for the US. And again, it goes to the theme of making sure you're invested outside of the US despite this pretty significant outperformance in the US over the last decade.
Yeah, I think that just keeps ringing in my head is like really understanding like what diversification means is really important, and just this idea of just owning more is not necessarily better. It's like really understanding what you own and why you own what you own, and is imperative.
Yeah, and I mean, we always talk about it as a jigsaw puzzle. All these pieces need to fit together to have a portfolio construction process that really works. And so we're not diversifying just to have diversification. Each piece is thoughtfully put into the portfolio, constructed to make sure that the client has the best risk reward, the best risk adjusted returns that we think can be delivered.
So, Matt, I know we're getting close to time, just in the sense of, we've been going for 50 minutes, and maybe we should use this chance for just a couple closing thoughts, and I'll give each of you sort of the last word here. I think I said it up front as a theme. This idea of separating your politics from your portfolio is really a very key factor in maintaining rational thinking and operating from this place of of objective thinking about your portfolio, more importantly, a financial plan, then driving your portfolio to help you really allocate appropriately. And so, Matt, like we've talked a little bit about, some of the headlines and the less certainty that there is relative to geopolitics, but there's been a lot of things that have come out of, everything from the president talking about, credit card interest rates, talking about, really helping drive or trying to push mortgage rates lower. We've talked about, constraints on pharmaceutical pricing, or we've heard headlines about this. Like, how does an investor navigate such an environment? And maybe you could just decide between you, Brian, Rusty, how you each want to maybe make a comment on that.
Yeah, and I think, one of the things I really feel privileged about of being part of the investment team here at Compositions is we've got very seasoned guys. So, they've lived through multiple market cycles, as have I. So I'll let them kind of bring their perspective. But I think my thought is kind of two comments. And you used the phrase earlier on, Nate, it's going back to the prior comment, it's having purpose with your money. And I think that's how we think about everything, is everything in the portfolio has a purpose. And we're hopefully we're able to convey that today, that there's a lot of thoughtfulness behind each purpose in the portfolio. The other piece is there's a lot of news flow and a lot of headlines, as you said, and it's sometimes candidly hard to get our arms around. And while we're still thinking through one, something else comes at us. But I think as we've built the portfolio, it's adding those multiple layers and being thoughtful in the diversification. But we've also tried to have diversification where not only we can play defense with it, but it can also be offense. And so Rusty brought up our positioning in defense companies. So that's one where, we know going in, the Trump administration was a little bit more pro-defense. And that's actually worked out even better than expected, because now we've got accelerating spending on foreign companies on defense in that piece of their portfolio. So those are the things we're looking at. We talk about, Brian talked about tips. Those provide a nice little inflation hedge to their portfolio, but we bought it at a time where we actually felt like the pricing on those had been overlooked and actually provide a little bit of upside of potential as well to portfolios. So we are thinking about pieces that actually can provide both the defense and the offense. Brian, what would you like to add?
Yeah, so I would just say that, policy uncertainty definitely makes it more difficult to invest. There's lots of policy proposals. And as investors, we just have to consider the impact to company profits from a given policy, but also importantly, the likelihood that it actually becomes law. So we try our best to predict what are some of the areas we might see policy changes. We do own aerospace and defense on the debt side, which again, we think are likely to benefit from increased defense spending, both in the US and abroad. We own a number of banks which are benefiting from deregulation. We've avoided companies with significant credit card exposure, just given the potential for policy changes in that space. And then another really good recent example is that we've avoided health insurance companies, just given the focus on healthcare affordability.
I'd add, we try to keep it simple on the equity side for sure, and it's really about earnings growth. I mentioned that earlier. Ultimately, stock prices follow earnings growth, and we made an adjustment to portfolios last year to add more non-U.S., and that was really driven by earnings growth improvements outside of the U.S. So, there is a lot of noise. I always like to find a really good piece of research and put it aside and read it a month later. Really good research is a little bit more durable than a day's worth. So I think it's really focused on that earnings growth, where we're seeing that growth, and making sure that clients have exposure to that earnings growth.
Matt, any final words before we wrap up?
No, I appreciate everybody tuning in today, and as always, we're here to answer any questions or talk through things in more detail.
Yeah, I would extend those comments to say thank you for your trust, your partnership, and the opportunity to serve you and your needs. If you have specific questions, please reach out to your financial advisor or reach out to us. We're happy to engage. This team makes themselves available to clients, so we're happy to engage and happy to help. And again, thank you for your time this morning or this afternoon, wherever you are. It's been great to be with you, and we look forward to our next webinar that we'll have coming up in February. Thanks, everybody.